You know, it's funny, during Dhanteras, when everyone's so focused on, the value of gold and all that, it got me thinking about a different kind of treasure.
Oh, yeah.
Understanding how venture capitalists decide how much to invest in startups.
Interesting.
Yeah. It's like a whole different kind of wealth, right?
Yeah, absolutely.
And that's exactly what we're diving into today. We've got some great research here that breaks down, the whole process of how VCs determine their average check size.
Right.
Which is super valuable if you're, knee-deep in the startup world or just curious about this whole VC thing.
Absolutely. I think it's fascinating how this connects to Dhanteras.
Yeah.
Just like people are, meticulously assessing the value of gold and silver.
Right.
VCs have this very specific process for figuring out, okay,
Right.
like how much do we actually want to invest in this startup?
They don't just throw darts at a board.
No. It's much more calculated than that.
Okay, so let's unpack this.
Yeah.
First things first, what exactly is fund size in the VC world?
Fund size.
And why does it matter so much?
Okay, so fund size is basically the total amount of capital that a VC firm raises.
Okay.
Think of it as their war chest, if you will.
I like that.
Fueled by the limited partners
Okay.
or LPs who provide that capital.
Got it.
And, the size of that fund, it really sets the stage for their entire investment strategy.
So bigger fund means bigger checks, right? Like they can just throw money at anything that catches their eye.
Well, not exactly.
Okay.
It's a little bit more nuanced than that.
Okay.
You see, larger funds tend to focus on later stage startups.
Okay.
The ones that are already showing some serious momentum.
Got it. So they're not interested in the horses that are just learning to walk out of the gate.
Exactly.
Okay, so where do the smaller funds come in?
So smaller funds are more like talent scouts.
Okay.
Always on the lookout for promising early stage startups.
Okay.
They typically write smaller checks initially,
Right?
but the potential payoff can be huge.
Higher risk, higher reward.
Classic scenario.
Got it.
Yeah.
So knowing the fund size can give you a sense of whether a particular VC is even a good fit for your startup.
Precisely.
Right. You wouldn't want to go knocking on the door of a late-stage investor if you're still in the seed funding phase.
Yeah. You got to do your research.
It's like trying to sell ice to Eskimos.
Exactly.
Right. All right, so let's dive into the actual mechanics of how they calculate these check sizes.
Okay.
Our research uses a really helpful example.
Yeah.
Imagine a VC fund with $100 million ready to be invested over a 10-year period.
Okay.
A cool 100 mil. Talk about a treasure chest.
Sounds like a lot, right?
Yeah.
But here's the thing. Not all of that money goes directly to the startups.
Okay.
Remember those management fees we talked about?
Right.
Those cover the VC firm's operating costs.
Yeah.
Keeping the lights on and such.
Gotta keep the lights on.
Exactly. And those fees are typically around 2% annually.
Okay, so over 10 years, that's a pretty significant chunk of change.
It is.
We're talking $20 million right off the bat, leaving them with $80 million for actual investments.
Right.
So even before a single dollar goes to a startup, the VCs are taking their cut.
Well, it's the price of expertise, I suppose.
Yeah, I guess so.
But it is a really important point for entrepreneurs to understand
Right.
that, the advertised fund size
Yeah.
doesn't actually equal the amount they have to play with.
So they've got $80 million left to play with. Did they just start divvying it up amongst the startups?
Not quite.
Okay.
VCs have to be very strategic about this.
Right.
They generally split their capital between initial investments,
Okay.
the first money they put into a startup,
Right.
and follow-on investments,
Okay.
which are, additional funds they pump into the companies in their portfolio that are really showing promise.
Okay, so it's like a two-pronged approach.
Exactly.
Support new ventures, but also double down on the winners.
Precisely.
Makes sense.
Our research uses a 50-50 split as an example.
Okay.
So in our hypothetical $100 million fund,
Yeah.
that's $40 million for initial investments,
Okay.
and another $40 million set aside for those crucial follow-on rounds.
So let's get down to brass tacks. How do they decide on that initial check size for those brand new startups?
Well, it really depends on their strategy and how many companies they're looking to invest in.
Okay.
For our example, let's say they're aiming to invest in 20 startups with that $40 million set aside for initial investments.
So that gives us an average initial check size of $2 million per startup.
There you go.
Simple math. But I bet the implications are huge for those startups.
Absolutely. But keep in mind that the actual amount can vary quite a bit.
Oh, sure.
Some startups might need more to get off the ground.
Right.
Some might need less.
Sure.
It all depends on their specific situation and the VC's assessment of their potential.
Got it. So they've made those initial investments. What about those follow-on rounds? How does that whole process work?
Well, VCs aren't just throwing good money after bad.
Right.
These follow-on investments are reserved for the stars in their portfolio.
Okay.
The ones that are really taking off. They're looking for impressive revenue growth, startups that are dominating their niche, or maybe experiencing rapid user acquisition.
Makes sense.
They want to fuel the rockets that are already soaring.
So it's not enough to just have a great idea.
Right.
You need to show them the numbers, the growth, the proof that your startup is on the right track.
It's like a first date.
Okay.
You need to make a good impression to get a second one.
I like that analogy.
And it really is about building that strong relationship.
Right.
And showing the VC that you're worth that continued investment.
Yeah, I think that's something we can explore further when we come back from the break.
Absolutely. And we're back, delving deeper into the world of VC check sizes. We've laid the groundwork now. Let's explore what this all means for you, the entrepreneur.
Exactly, because knowing how the game is played is only half the battle.
Right.
Now we need to figure out how to use that knowledge to our advantage.
Absolutely. One key takeaway here is the importance of demonstrating real traction to attract those coveted follow-on investments.
So it's not enough to just have a brilliant idea.
No.
You need to show them the numbers, the growth, that validation from the market that says you're onto something big.
Exactly.
Yeah.
Think of that initial funding round as your runway.
Okay.
To prove your concept, gather data, and build a compelling case for why they should double down on your success.
Okay, so you've got the initial funding, you're building that runway. What else should entrepreneurs be thinking about when it comes to these follow-on rounds?
It's also wise to be upfront and ask the VC about their portfolio strategy.
Okay.
Are they the type to spread their bets across a large number of companies, or do they prefer to concentrate on a select few?
Why does that matter?
Well, it can actually impact the size of their checks.
Really?
A VC with a concentrated portfolio might be able to write larger checks for each investment because they're putting all their eggs in fewer baskets, so to speak. Whereas a VC with a more diversified approach might need to spread their capital a bit thinner.
So it goes back to that balance between risk and reward.
Exactly.
A concentrated portfolio is a bit riskier, but potentially more lucrative if those few bets pay off big.
Precisely. Knowing a VC's portfolio strategy helps you manage your expectations.
Right.
And target the right investors for your startup's specific needs.
Yeah.
It's about finding the right fit.
Okay, it's all starting to come together. We've got fund size management fees, those all-important follow-on investments, portfolio strategy. Is there anything else entrepreneurs should keep in mind as they navigate this world?
There's one more critical point we need to address.
Okay.
And that's the difference between early stage and late stage investment strategies.
Okay.
It's crucial to understand which type of VC you're dealing with.
Okay, break it down for us. What are the key differences?
Early stage VCs are all about nurturing potential.
Okay.
They're willing to take bigger risks on companies that are just starting out,
Right.
those fledgling businesses, with a great idea, but maybe not a ton of data to back it up yet.
Right.
Their initial checks might be smaller, but they're often more open to providing follow-on funding as the company grows and proves its worth.
So they're in it for the long haul, guiding those startups through the ups and downs of those early years. They're looking for those diamonds in the rough, the companies that could become the next unicorn.
That's a great way to put it. Now, on the flip side, late-stage VCs are all about scaling already successful businesses.
Okay.
They come in with much larger checks, but they also expect to see significant traction.
Got it.
A clear path to profitability, and a strong management team already in place.
So they're not as interested in nurturing potential? They're looking for businesses that are ready to hit the gas pedal and dominate their market?
Precisely. And they're typically less involved in the day-to-day operations,
Right.
trusting the existing management team to execute the growth strategy.
So entrepreneurs need to be aware of these different approaches and tailor their fundraising strategies accordingly.
Absolutely. As your business matures, your funding needs will evolve, and you'll need to target different types of investors.
This is gold, folks. It's like we've cracked the code of VC investing.
I know, right?
But before we get too carried away, let's recap those key takeaways for our listeners, especially those navigating the startup world.
Certainly. First and foremost, fund size matters. Don't waste your time approaching a VC whose fund size doesn't align with your stage of growth.
Right.
Do your research and target those investors who are actively seeking companies like yours.
It's all about finding that sweet spot. You wouldn't go to a bakery looking for sushi.
Exactly.
Right.
Second, don't be fooled by a large headline fund size. Remember, those management fees can eat into the investable capital. Always look beyond the surface.
It's like that old saying, don't judge a book by its cover, or in this case, don't judge a fund by its size.
Well said. Third, remember those follow-on investments. They're crucial for sustained growth, but you need to earn them.
Right.
Use that initial funding wisely to demonstrate traction, validate your business model, and build a compelling case for continued investment. Show them the numbers, show them the growth, show them the potential.
Show them you're worth betting on. Make them believe in your vision.
Exactly. Fourth, don't be afraid to ask VCs about their portfolio strategy. Understanding their approach to risk and diversification can help you set realistic expectations and find the right partners for your journey.
Communication is key.
It is like any relationship. And finally, remember that early-stage and late-stage investors have different priorities and expectations. As your company evolves, so should your fundraising strategy. Adapt, evolve, conquer.
I love that. So it all comes back to that idea of knowledge being a form of wealth. Just like those savvy investors during Dhanteras, we've equipped ourselves with a deeper understanding of the VC landscape.
Absolutely.
But we're not quite done yet. We'll be back to wrap up this deep dive and leave you with some final food for thought. And we're back for the final stretch of our deep dive into the world of VC check sizes. We've, crunched the numbers, explored the strategies, and now it's time to bring it all back to that idea we talked about at the beginning.
Right.
Dhanteras, the festival of wealth and prosperity.
It's been quite a journey, hasn't it?
It has.
We've gone from, assessing the value of precious metals to understanding the, intricate workings of venture capital.
Right.
And through it all, we've seen how knowledge itself can be a valuable asset.
Yeah.
A form of wealth in its own right.
Remember that idea of Dhanteras we were playing with?
Yeah.
Well, I think we've successfully unearthed some serious knowledge gems today.
I think so too.
Kind of like those savvy investors, carefully evaluating their options during Dhanteras.
Right.
We've learned how to navigate the VC landscape and make, smarter decisions.
For sure.
Whether we're seeking funding or even considering investment opportunities ourselves.
That's a great point.
Yeah.
It's all about informed decision-making, isn't it?
Absolutely.
Understanding the forces at play, the strategies involved, and the potential outcomes.
So, as we wrap up this deep dive, let me leave you with a thought-provoking question to ponder. How might understanding these VC calculations and strategies change your approach to the world of startups and investments?
Will you be more discerning when choosing which VCs to approach? Will you pay closer attention to their fund size, their portfolio strategy, their track record with follow-on investments?
Will you be more strategic in using that initial funding to demonstrate traction and secure those coveted follow-on rounds?
Good question.
Will you see the value in building strong relationships with VCs who align with your vision and growth trajectory?
It's all about finding the right fit.
It is. These are all important questions to consider as you navigate this, exciting and often complex world.
For sure. And remember, there's always more to learn.
Oh, yeah.
More insights to uncover, more strategies to master.
The journey of knowledge never really ends, does it?
It's a lifelong pursuit.
So keep exploring, keep learning, keep pushing the boundaries. And who knows, maybe we'll do another deep dive into a related topic sometime down the road. Until then, happy Dhanteras to all. May your knowledge be your greatest asset.